Okay, so for question 2, you can see it's 30 marks. If we scroll down to the required, that's where you start. Is they have asked you to calculate the VAT payable or refundable for the 2-month period ended 30 April. If they tell you it's a 2-month period, make sure that in the information, if they tell you it's per month, that you have to go multiply it by 2. This is something that a lot of students will miss because you're under pressure, you are stressed. So be mindful of that. And then they tell you clearly state if it is import or output VAT. So you have to go distinguish between what is output VAT. Now remember, output VAT, we said, is linked to your income or revenue. This is just to help you sort of determine where it needs to go. Input VAT is normally your expenses / purchases. Okay, so that is just to help you sort of distinguish between the two if you can't remember what it is. And then they tell, if an amount has no VAT implications, state your reasons. So that would be, is it 0 rated? Is it exempt? Or is it potentially denied? So those are the type of reasons you would have to supply. And then they tell you round to the nearest rand, so you round it up to the closest rand. Okay, so that's part 2.1. 2.2 says, assuming the company use e-filing to submit their returns, when must the VAT 201 be submitted for the 2-month VAT period? So this is a theoretical question. When do I need to submit that return? If I'm using e-filing, so I'm doing it online. Okay, and then question 2.3 is, if the beds for us submitted their VAT return on time, so their VAT return was on time, but they only paid the amount on the 18th of June. Discuss what the consequences will be. Now, as soon as they talk about consequences, you should actually know that they have not met the normal requirements. Okay, so the normal requirements for your payments is before the 7th of the next month. Okay, and this would have to be at the end of the month. So that is 30th of April. Is when you normally have to submit it. If it's online, if it's manually, by the 25th. Okay, so let's go read the information to work out the VAT payable and see what is output VAT, what is input VAT. Okay, so here they tell you they are registered for VAT vendor. Okay, well, we know that, seeing we have to calculate the VAT. They sell beds and mattresses to general public, both locally and abroad. We're busy with a 2-month VAT period. All amounts include VAT. Okay, so the amounts are inclusive of VAT. As soon as amount is inclusive of VAT, to work out only the VAT portion, we would multiply it with 15, which is the VAT we want, divide by 115, which is the amount inclusive of VAT. Okay. Unless otherwise stated, and they tell you the VAT rate is 15%. Okay, so that is just in case the VAT rate changes, you know how to get to the answers. Now, number 1, they tell you sales. There's local sales and there's export sales. Now, why have they distinguished between the two? Remember, local sales is standard rated, export sales is 0 rated. And sales is income or revenue, so this would be put under your output VAT category. Okay. Then number 2, the bank statement reflected the 950 has been taken off for bank charges. Okay, so we've got 950 for bank charges, and we've got interest of 2,192 Rand. Okay, now remember, Bank charges is a service that is provided by the bank, so we can claim input VAT and at a standard rated supply. Then the interest that have been earned on a favorable bank balance. So a favorable bank balance makes this income. Okay, so this is interest income, which you would show under your output VAT, but interest is an exempt supply because it is financial services. Then your microwave costing 1,400 was purchased for the staff canteen. Now remember, as soon as we see a purchase, it would be under input VAT, but the fact that it's for the staff canteen makes it an entertainment expense, which is denied for VAT purposes, okay? Then the next one is rental of shop premises is 36 per month. Now what did I say? We do a 2-month VAT return. So you have to multiply this by 2 to get to the value to include in your calculation. Now because that is also an expense, it would also be input VAT for your rental amount. Then we've got insurance of 3,800 was paid in respect of the business building cover, and 12,000 was for the double cab bakkie. Okay, and they tell you it's for a 2-month period. Now remember, for your motor vehicles, things that are defined as a motor vehicle, you will not be allowed to claim input VAT. But they say any other expenses relating to that motor vehicle, so your insurance, any petrol, any so it's insurance, any repairs, any maintenance, whatever. For those items, you will be allowed to claim the input VAT. So it's only the purchase of the vehicle itself that is denied, not the other expenses you have to incur for that specific vehicle. Okay, so that means we will be able to claim the input VAT for the insurance amounts as well. Then we've issued shares. Now, if we issue shares, we are getting income as well. However, issue of shares is also a financial service, so this is also exempt from tax purposes. Number 7, they talk about your double cab bakkie. Now we know this is a motor car as defined. So input VAT is denied. Okay, next one, second-hand beds have been purchased from a non-vendor. Now remember, if we've got second-hand and there's a non-vendor, we can claim notional input VAT. Okay, now even though this amount is excluding VAT, according to this question, you are going to work it out. So you work it out as if VAT is included. Okay. So this is an exception to the rule. So they're putting the excluding VAT to confuse you, to use the incorrect rate. But because it's from a second hand and it's from a non-vendor, they would not have included VAT. But there's an assumption that VAT is already included in their price, so that is why we work it out as if VAT is included. Then the next one, we've got a hailstorm that destroyed the front shop window, and 14,000 excluding VAT was repairs. Now, because this is excluding VAT, here you would actually multiply it with 15 over 100, as opposed to the 15/115. So this is what you had to see in this one that is different, and this would also be input VAT. And then we've got a delivery vehicle was sold to a non-vendor for 83,000. Now the rule says if I sell a vehicle and input VAT was initially declined, I do not have to raise output VAT. Now delivery vehicle is not defined as a motor car. So that means I have to raise output VAT on that amount. Okay, then we've got new office chairs were ordered on the 20th of February. Okay, now as soon as you see February and that, you have to go think about our 2 months would be March and April 2020. Now the rule for VAT is the earlier of payment or invoice date. Okay, so just remember that concept when we're going to read this, because they have indicated February date. So that is generally what you should pick up if you see it's different dates to what our period is. Okay, so we've got new office chairs. They were ordered on 20 Feb. Okay, so the order date is irrelevant. An invoice of 8,900 for the 2 chairs was 23rd of Feb. And then they delivered it on the 4th of March, and the payment was made also on the 4th of March. Now, because of the fact that we do the early of payment and invoice date, we would have already included this in our Feb 2020 return. So we will not have to do anything with it. So what you have to do for this one specifically is you would just state there under your input VAT that this has already been claimed on the invoice date in February. Okay, so that is actually your reason. So that is why you would do nothing with us. Okay, then we've got new mattresses were imported from France. Now remember, if we import something, you need to remember, is it from our BLNS countries? Yes or no? Now, France is not part of Botswana, Lesotho, Namibia, or Swaziland. So that means we have to add an additional 10% to the custom duty value when we work out the 15%. So how do we work it out? We work it out by using our custom value plus the custom value multiplied by 10%. Plus any import surcharges. And then once you've got that total you multiply with 15% to work out the input VAT that you can claim. Okay, so this is also input VAT. Then salaries and wages. Salaries and wages does not form part of your enterprise. It's not part of the business supply of goods and services, so it is not carrying on an enterprise. So that's why no VAT would be claimed on that. Then we've got our sales manager. Okay, he went to Cape Town and he had the following expenses. Now, as soon as they break down the expenses, that means different expenses, different requirements. Okay, so all you need to see is he was away for 6 days. So the first one is your car hire. Okay, this was per day. Now, for your car hire, we will not be able to claim this because it is still considered as a motor car as defined. Okay? Your fuel is 0 rated. Your insurance, we said, is standard rated. Your accommodation is also standard rated because he was away for work, so that is not seen as entertainment. Your meals, because he was away for work, it will also be standard rated because this is seen as a subsistence expense, which is the exception to your entertainment expenses. Then your Uber, your taxi to and from the airport. Now that is an exempt supply because it is transport by rail or road, and it's by a fare paying customer, so it's an exempt supply. And then your return airfreight ticket, this is standard rated supply. Okay, because it's not by road or rail. And then they give you the depreciation for your capital assets. Now remember, depreciation is a non-supply. So you just indicate depreciation as a total amount rather as for each and every item. Okay, so let's quickly take a 10-minute break and then we'll continue with now doing the physical calculation for this question.